Hello, thanks very much for tuning into this webinar. I'm Daniel Coatsworth, the editor of Shares Magazine, and today we're going to talk about how to pick stocks, getting the basics right. So we'll have to do a quick disclaimer before we get going on this session. The value of your investments can go down as well as up, and you may get back less than you originally invested. Now, we don't offer advice, so it's important that you understand the risks. If you're unsure, please do consult a suitably qualified financial advisor. And just remember that past performance is not a guide to future performance. Some investments may actually need to be held for the long term. So in this session, I will cover how to pick stocks using two simple valuation metrics, the P and the price to book, where you might find some important bits of information, the basic guide to reading financial results statements, 5 ways to check if a company could be a good or bad investment, and when to consider buying or selling. But I won't cover in-depth accounting stuff, and I won't look at technical analysis either, which is sort of reading chart patterns. So before we get going, it's probably worth asking, are stocks and shares right for you? You may think that's a bit of an odd question at the start of a webinar about stock picking, but I think if you're either inexperienced or you've only been doing this for a very short amount of time, funds might actually be a bit better starting point for you than individual company shares. If you've got a portfolio and it's only got, say, 2 or 3 shares in it, and one of them goes and encounters some bad news and sort of experience a big share price fall, I think you really feel the pain in your portfolio. But if you've got some funds instead, then if something goes wrong with one of the holdings in a fund, well, you get all those other funds in companies inside the fund. They'll act as a cushion, and you shouldn't feel the pain as much. It's just sort of trying to re-emphasizing the importance of diversification. And so if you're thinking, well, why should I sort of sit and watch this webinar if you're telling me to buy funds now? Well, actually, the stuff I'll be discussing is exactly what will be going through the mind of a fund manager when they're picking stocks. So it is all relevant. And even at the end of this webinar, if you think, well, okay, thanks for giving me some insight into how to pick shares, but I'm actually just still going to go with the funds route, it's still very valuable to you, because I say it's stuff that you do need to know investing, no matter how you go about doing it. And just to re-emphasize, this event is actually aimed at someone with only modest investing experience. You don't need to be an expert to understand this information. And as we're going through, you can ask questions, because I'll have a question and answer session after my presentation, and you can ask questions whenever you want throughout the webinar, just using the little box on the right hand side. So let's start off with some of the key valuation metrics. So we'll start off with the P and price to book. So P is the one that's really used by investors as a starting point, and really it's quite easy to understand. The P relates to the P in share price, and the E relates to the earnings and earnings per share. So you can get share price information from the Youinvest website or places like Shares Magazine or the London Stock Exchange. Earnings per share figures are published on the financial results. So you just look at either the latest financial results from a company, or you could look for forecast information. Now, this is quite important. The stock market's forward-looking, and published results are historic. So therefore, I think it's probably better to use the forecast ones, because the stock market is all about pricing in what it thinks will happen. So you can get this information either from stock screening systems such as SharePad or Stockopedia, or you can go onto Reuters website, where it does have that information for free. And what it does is it collates all the forecasts from the analysts who work for investment banks and stockbrokers, and then it will give you a consensus figure for it. So I always think it's much better if we give some examples, and rather just sort of simply presenting random figures. So if we just give you the example of WH Smith's. So when I was putting this presentation together, its share price was £19.99, and its forecast EPS for the current year is 126.2. So to calculate a PE, you simply take the share price and divide it by the earnings per share figure. So that gives us a PE of 15.8 for WH Smith. But what does this really mean? So I think in order to put it in some context, you do need to either compare it against similar companies or against the market. I'm going to talk to you a bit more about WH Smith in a second, but just give you this sort of rough guide to PE ratios. This is like a framework. So I think anything with a figure that's less than 12 is probably really good value. This is sort of really interesting territory. It could be a bargain, but it also could be cheap for a negative reason. Something between 12 and 17 times, you could argue is fair value. So I think this is probably for a low to medium growth company. And something above 17 times might be a high quality business, it might be a fast growth one, or it might simply be that the stock is just overvalued. Because important to make the point, this is a subjective guide. So you might come across other commentators who may say different numbers for this sort of rough guide to PE ratios. Some people are actually quite happy paying 20 or 25 times for a stock before they would consider it to be overvalued. But I think this framework will certainly give you a good starting point. So just moving on now back to WH Smith. Here I'm going to talk you through how its business model works, and then a couple of companies which are kind of similar, and then we'll compare the PE against the market as well. And hopefully this will help put this in a bit more context. So WH Smith as a business is kind of split into two. One half is the high street business. We kind of know that high street is tough. Retailers across the board are finding things really difficult with low footfall, people visiting their shops. WH Smith is doing okay, but not amazing on the high street. But where it is doing very well is its travel business. So this is shops that you'd find in an airport, in a motorway service station, train station, and also some hospitals. Here, the growth is much better, and this is kind of the key earnings driver for the business. So I would say I would probably call this a medium growth business, and therefore a PE of 15.8 sits in between this 12 to 17's range. And you could argue it's probably the market is pricing it in the correct way for against its growth. And then there isn't a company that does exactly the same as WH Smith on the stock market, but I would say the Works is its closest comparable in terms of being a high street retailer, because like WH Smith, it's also selling sort of books, and there's bits of stationery in there, and it's more of a value proposition. It's a lot cheaper. It knows its audience very well. So you may ask, well, if it's on a P of 8.5, why is it so much cheaper than WH Smith's? I think it's because you need to look at several factors. Well, the Works has been on the stock market for only a short time, and in that period, it's already missed earnings expectations. It's come out with some bad news, and investors in general really hate it when companies float and then can't deliver within sort of a short period after they've been listed. It's also got this high street factor as well, where investors are very nervous about companies that are so reliant on the high street to get their earnings. And such, you can understand why it's on a lower rating. But a contrarian investor might say, well, is all the bad news priced in? That's a really low rating. Is there an opportunity for me? Now, I am not allowed to make any recommendations about which stocks you should buy or hold or sell. So all I'm saying for this webinar is when you have a situation where something is very cheap, it's probably worth you going to do a lot more research to try and understand the risks and rewards involved. Now with SSP, this is probably the most direct rival to WH Smith in terms of its travel arm. So SSP may not be a brand which you're familiar with, but I bet you've used its services without you perhaps knowing. So if you go to a train station, you might see Burger King or Marks and Spencer food. Well, the chances are those companies are not running those sites in the train station. It's probably SSP under a franchise. It's also got some of its own brands as well, such as Upper Crust. So SSP and WH Smith on its travel side both benefit from something called a captive audience. If you're at a train station or an airport, you're waiting to do something.
And so you haven't really got the time to go and shop around. You kind of just got to make a decision there and then, and use the sort of probably limited selection of places in which to either to make a transaction, or you simply just don't do it. So I guess the question you would then ask is, why is SSP on such a higher rating from a PE perspective than WH Smith's? I would put it down to type of business that it is. It's more global than WH Smith's. And also it's to do with, it's just selling food and drink. So I would rate that as perhaps a non-discretionary spend. If you're going on a long flight and you don't want to buy sort of say EasyJet's expensive food, you may want to think, I'll have a decent meal before I get on the plane. Well, this is probably non-discretionary, but if you're going to go and think, well, I'm going on a train journey, and do I really need to go to WH Smith's and buy a newspaper or a packet of Werther's Originals? I don't necessarily have to do that. So that's why I think SSP probably deserves to trade on a higher rating than WH Smith's. But the question you should then ask is SSP trading too high versus its growth prospects? So that would be your logical point to then do your own research. So if you then look at the FTSE 350, which is an index of the 350 biggest companies that are listed on the London Stock Exchange with a certain type of listing, well, that's trading on a P of 14.7. So that's just a little bit less than WH Smith's, but you do have to think, well, it's not entirely in sort of apples for apples comparison, because that index of companies is made up of lots of different sectors, and lots of those perhaps will be trading on much lower PE ratios. Now, banks would definitely be one of them. And this sort of brings us neatly to our next valuation metric. So this is when the price to book valuation metric might be better to use with certain industry sectors. So price to book is sometimes known as price to net asset value or price to NAV. And it's kind of looking at the value of a company on the stock market against the value of its assets. So you're looking at these assets and liabilities. So assets might be property, it might be equipment, money that's owed to it by suppliers, or some of its brands and patents. And liabilities could be money it owes to other companies, and money it owes to the bank as debt. Sometimes investors think, well, I'm not so sure that we should really be including some of those assets in our calculation. And by this, I probably mean that referring to the intangible assets. So this is patents and brands, intellectual property. So if you're not comfortable about using those, you can use something called price to tangible net asset value as a calculation. So I think if you go onto a stock screening service such as SharePad or Stockopedia, they'll all give you the options of using either of these things. And I think what you're looking for is a figure below 1, because the sort of the goal of an investor might be, I want to buy a pound's worth of assets, but I only want to pay 80p. So I think if you're looking at banks and insurers and sort of property firms like house builders and investment trusts in particular, it's probably best to use the price to book. But investing isn't always straightforward. Of course, there's always an exception, lots of ifs and buts. So price to book perhaps isn't suitable for software companies, for example. So Microsoft is, it may not have lots of physical property, but I say it's probably got masses of intellectual property, so that some of these intangible assets. It trades on 8.2 times book value. So if you just recall what I was saying just a little bit earlier in this webinar, that we were looking for something on a figure below 1, then you might think, blimey, Microsoft's really expensive. But I don't think it's the suitable metric to use to value the business. You're probably better with PE. And here it's on just below 25 times. So a premium rating, but you may argue that it's got the right qualities and very large amounts of cash flow, perhaps to justify having a higher rating. So if I just give you an example of a stock that's currently trading on a very, very low rating, is Into Properties would be a good one. So this is a sort of a property investor, and it specializes in shopping centers. So there's several reasons why it's on a very low rating. First, is that the market, it doesn't really believe the stated value of its property assets. It thinks that they're worth a lot less. It's also its customers or its tenants are the shops that are inside these shopping centres. Now they're under pressure, and they're putting pressure on the landlord being Into to say, well, we really want rent reduction. So Into's assets may not be worth as much as it's stated, and its income could be falling because of these potential rent reductions. So you can understand why it's on such a low rating. However, this is going back to the concept of the being contrarian. You then have to think, well, is too much bad news being priced in? This is a stock that's had, it's been in takeover talks with Hammerson. That didn't work out, and there's been rumors of takeover interest from other parties. We haven't seen anything solid yet. But you can use these valuation metrics to help pinpoint stocks to go make further investigations. Don't ever just simply make your decisions on those numbers alone. But Into properties might be something which, particularly if you're quite comfortable with the property sector, you might want to look into further. And then if you think about a couple of sectors, well, the mining sector, analysts tend to value this on a net asset value basis rather than PE. They like to value sort of the established businesses on perhaps 1 to 2 times NAV. So here, Polymetal is a Russian gold and silver miner. It's trading on 4.1 times. So on that basis alone, you would say this does look expensive. And I think investors have been getting excited about those precious metal prices rising this year, so they've been eager to get exposure. But then Antofagasta, which is a copper miner, is only on 1.4 times. So going back to the idea that analysts would probably rate a company like this between 1 and 2 times, it's perhaps more interesting from a valuation perspective. And if you're looking for opportunities in the mining sector, you might want to say, I'll look at the lower rated ones to see, is there more of an opportunity for me to potentially make some money in the future? And the house builders, well, if you think about that sector, property market's kind of stalled. House builders have also been facing lots of cost inflation for all their materials. So one would naturally expect that sector to be weak. So I am a bit surprised to see those, both that Crest Nicholson and Barrett are trading above 1 times net asset value. But again, these are great sort of indications to help you start your research. Don't simply base your decisions on them alone. And then I'll just have my eyes sort of go straight to Greggs when I see it on this presentation for being a stock that's on a high PE. If you recall, I was saying about W.H. Smith's being sort of a medium-term growth business and perhaps is correctly rated between that 12 and 17 times forecast earnings. Well, Greggs is a sausage roll seller, which to me would suggest it's kind of, surely that's got to be no more than medium-term growth. So why is it trading on a very high premium rating of 24.5? So you then need to look at what's going on with the business. Well, Greggs introduced the vegan sausage roll, which got a lot of publicity. And when I first saw that, I thought that's quite exciting, and it might get sort of a one-off boost. People sort of curious and wanting to try it. What's actually happened is since then it's come out several times by saying this has sort of helped get more people through its stores, and they're going back for more. So the analysts have been upgrading their earnings, and that's been helping to drive up the share price. I also think there's this sort of the idea that the vegan movement is now in the mainstream, and people are looking for ways in which to play this new theme. The UK stock market doesn't really have a lot of opportunities to play the vegan theme, apart from something like Greggs, which has actually recently said it might introduce vegan versions of all of its products. So you can perhaps then go on to understand why investors seem to be happy to pay a higher rating. We'll come on to Greggs again a bit later. And I want to talk to you about why it's important for companies to be able to sustain good news if they're on high ratings. Otherwise, they may potentially see a D rating. So from everything we've discussed so far, I've kind of explained to you the relevance of PE, the relevance of the price to book. So I will just look at Marstons as another example to try and reaffirm the key message from this webinar is you must look at numbers and strategy, never both in isolation. So Marstons, it's on a PE of 8.8, so it's below the 12 times we're looking in terms of bargain territory. It's on a price to book of 0.9, again below the 1 times level that we look for potential bargains. So on paper, it's really cheap. It's also potentially going to pay you a dividend of yielding about 5.9%. So if you bought a grand's worth of Marstons shares, you may potentially expect to get about 59 quid a year in dividends. Although it's worth pointing out that companies can reduce or cancel the dividends whenever they want. They're never guaranteed payments. So on paper, it looks really cheap. So let's have a look at the strategy. So I think about 10 years ago, it was really sort of taking off in terms of building new pubs. They were doing very well and generating lots of cash that it could reinvest into its existing pubs, making them look nice. So it was all going very, very well for the business. And then perhaps 3 years ago, we saw the casual dining sector go through a really horrible stage where it realized that restaurants had grown too fast. There just wasn't the demand for all the amount of outlets they were having. Of course, this affects the pub sector as well, because restaurants and pubs are both places that you go to eat and drink. And so Marstons was faced with this sudden, it was intense competition from restaurants. The restaurants were getting into trouble. There's some of them having to close, and certainly prices were being slashed. So lots of discounting. So Marstons was having to perhaps be having a look at its own pricing. At the same time, is also facing labour cost inflation and also energy and food cost inflation pressures as well. So its profit margins were being squeezed, its industry backdrop was looking very shaky, and the company has a lot of debt. And so what management have now said is that we need to really scale back this business in terms of growth, sell off some non-core assets, and let's just focus on paying down that debt. And it's a bold decision by management, but really what they're trying to say is we want to make sure that if times get even worse, we're in a financially sort of strong shape to survive. So now you understand that strategy, you may begin to understand why it's on a discounted rating. So the next stage would be for you to perhaps weigh up, is it still attractive, that price, given the yield that you could potentially get? Are there risks to that dividend, and so on? So you can see how this is a platform for your future research. So in terms of trying to understand the strategy, where do you actually get this information? Well, companies have to report their financial results twice a year, and some of the bigger companies will probably issue trading updates every 3 months as well. So you could go and see this information, which has to be published to the public via Shares Magazine website. You can go to investigate.co.uk website. Have a look at the annual report as well on a company's website, because they tend to give you some really good broad overview of everything that's going on. I would also recommend you read the business sections of the BBC, the Times, and some of those are the major newspapers and websites. They're very good at talking about companies on the stock market and about what's going on, and it really will help you become more informed. Have a look at some specialist investment websites, magazines, look at fund manager websites. I'll give you a good example of Lindsell Train. Every month they issue some commentary about their funds, and they talk about 1 or 2 stocks, and they give really, really good insight into why they like them, or perhaps why they might have gone off something. And if you want to get a bit more information about the historical stuff with the financials of a company, well, a company, a sort of website like Morningstar might be a good destination to consider. And so once you have a look at these financial results, they can be a bit daunting, particularly if you're not comfortable with looking at them before. They're full of numbers and you don't really know where to start. So my suggestion is you look at it in a sort of couple of stages. First, look for revenue, pre-tax profit, the dividend and cash flow. You really want them all to be going up. If it's in a net debt position, you want that to be falling. Even better, you want it to be in a net cash position, which would show a sort of a financially stronger business. And please look at a 5-year trend. Don't just look at 1 year, because sometimes there could be good news which might flatter profits. Maybe they've sold a big big property which will boost profits, or it might just be a blip and they're having a bad time but they can quickly bounce back. But if you look at a 5-year trend, you get a much better picture of a company. And then perhaps most important is to look for the outlook statement. So as I sort of said earlier, the stock market is forward looking. It's all about pricing what it thinks will happen. So these financial results are really good opportunity for investors to get nuggets of information about how a company's thinking. So an increase in the dividend is a sort of a natural indicator that company must be quite confident about its situation, certainly about its financial stability. Otherwise, it wouldn't be handing cash out to people. But the outlook statement is like a summary from management. So it might be the chief exec or the chairman talking about what's coming up for a business, some things to look for. And it might be flagging that, say, last year we had a one-off contract. Just remember this year it's not going to be coming up again. And so they're also giving this sort of overview about what's going on. And here you might get, with some of the very big companies in the stock market, some sort of guidance about how much money they may think they may make in the future. So if I don't know if anyone's familiar who's tuning into this webinar knows the company Dunhams. I'm just going to talk to you about some interesting stuff that happened a couple of weeks ago. This is like a homewares retailer. Its financial results said that revenue was going up, profit was going up, the dividend was going up, and you were getting another special dividend on top. Net debt was falling. And it said the start of the new financial year was going very well. And so all of those things I've just been mentioning, saying what should you look for to find indicators of something that's doing well? Well, it ticks all the box. So you may think, looking at this chart I'm displaying now, why the sudden drop? So it fell by nearly 8%, and that is all to do with the outlook statement. The management came out and said, look, we've had a brilliant time, but we're now getting a bit nervous about how Brexit might impact consumer spending. And then analysts were getting a bit worried because there was some information in the results which indicated for the first time that online sales were having actually lower margin than the ones from its property stores. And so they were thinking, oh, crikey, this is, we thought that online potentially might be a higher margin. So there was this sort of sudden shock. And I think then if you look at this share price, you can see for most of this year, it was on a real rally. And investors have been presented with this information where everything was going fine up until now, and now the outlook's a bit gloomy. So you can kind of understand why some people perhaps wanted to take some profit. And also it goes, if you just look at those valuation metrics, Dunhams is quite expensive. And now we're sort of being presented with some potentially bad news. This is the sort of thing that might trigger a bit of a sell-off as well. So let's have a look at 5 ways to check if a company could be a good or a bad investment. And here I would sort of make the point that I could probably do 50 or 100 of these, but I just wanted to give you a flavor of some of the things to think about when you're doing your investment research. So first of all, does it make a good return on the money invested in its business? And here we're looking at something called return on capital, or ROCE. Unfortunately, nothing to do with Sylvester Stallone, but it's a sort of an indicator to see how well a company is investing its money and how much money it's making off that back of that investment. So you'd look at earnings before interest and tax and just divide it by the capital employed, which is total assets minus current liabilities. Some companies will give you this information in their sort of annual report. You may have to go onto a stock screening website to get that data. Secondly, does the company have a competitive advantage? If I was looking for an investment, I think I'd want to put my money into a company that's doing something a bit different from everything else. If there were 3 companies all doing the same, I guess people would just choose, certainly if you're a customer, choose the one that's the cheapest to use. But is that really the best way? So I kind of like companies that do something a bit different. I'll give you a few examples. Now, Pret-a-Manger is not on the stock market, but I think it's a great example of how you think in your mind of a brand that's deemed to be a bit higher quality. I know if I'm thinking I want to go out and get some lunch and I don't fancy a sort of a sweaty egg mayonnaise sandwich from the local supermarket, I want something a bit better quality. I might then just go to Pret a Manger because it's got this reputation of being a bit different. So that's its competitive advantage. Rightmove is another one there, which you'd think of is it's got the most amount of properties listed on its website. Therefore, it gives customers the greatest choice. And to me, that would be a competitive advantage as well. You could think of Harley Davidson. It's got this amazing reputation for quality bikes. And then Sky is an interesting one. You may not think of this as a competitive advantage, but it makes it really difficult for you to actually leave its service. If you wanted to cancel a subscription, then this is called something to do with the switching effect. If you can try and lock in customers and kind of block them any way you can from going to a rival, that is actually deemed to be, from an investment perspective, a competitive advantage. So next one, what's the company's track record in more difficult market conditions? Now, I think a lot of investors spend too much time thinking about what could go right and not enough about thinking what could go wrong. I would suggest here that you would go and look for years where the economy is going through a bit of a bad patch. So 2008 might be a great example. 2002 perhaps might be one to look at. Just see what the decisions have been made by people. We were talking earlier about Marstons making this sort of clear decision to sort of give up fast growth in exchange for concentrating on making the company financially stronger. Certainly was able to cope in more difficult market conditions. If you think about some of the big names in business today, I reckon they've all become successful in the last 10 years. So here I'm thinking about Just Eat, WeWork, maybe Purple Bricks. So the key thing is that they've all kind of been successful in the last 10 years, but they haven't actually been through a period in that 10 years where the economy has been really difficult, or certainly the stock market hasn't crashed to such a level. So you could argue that their business models are unproven in an economic downturn. So next one, are debt pressures a distraction to management? Unfortunately, we've seen this with Thomas Cook this week, where the company basically was drowning in debt and sadly has collapsed. Debt is a real killer for companies. When things go wrong and their earnings start to fall, they still have to pay these debt repayments every month. And I think it's when you've got a company who is just being asked by investors only about debt issues and not about how the company's going, then you're in a bit of a problem. I remember about 10 years ago, I was interviewing Enterprise Inns. I spent a whole hour literally talking about their debt repayment structure. I actually wanted to talk more about beer and sort of how their pubs were going. But then it was a great example of a company where the market was only interested in the debt. Basically, was it going to stay alive? And more recently, a good example would be Petra Diamonds, where everyone's really worried about falling diamond prices and how the company is in under pressure financially to try and repay its debt. And then just the fifth one is to try and be wary of a company directors who talk about the share price. I think it's if you're reading something or you see a presentation and a director is sort of moaning that their share price is undervalued, I think it's a bit of a sign of desperation. Companies should be focused on running their business. The stock market, i.e. the group of investors, they will decide if the shares are undervalued or not. Quite often company directors have their bonuses linked to hitting a certain share price target. So they may just be trying to talk it up to hit their bonus. Might be a company trying to raise money as well. They would want to do so at the highest share price possible. So I just don't like this at all. I think it's a real red flag if I see a company director talking about the stock. So let's think about, what do you do in terms of thought process when you actually want to buy something? Well, valuation is extremely important here. You might find a fantastic business, but if the price is too high, then it's a risk that particularly on something on bad news, it would potentially fall quite hard. Valuation really does matter. So I would go and look at the latest announcements about a company and check if there's any sort of signs of sort of concerns about it's going to be a tough period coming up, or something's not quite going right, or profit margins are falling, then I think, well, if you still like that company, maybe you want to sit on the sides and wait for a better entry point. But if everything's looking good and the valuation is perhaps not too excessive, then that's you really might want to consider making a purchase then. But really, and this is something I want to keep saying, is you've got to form a rounded view. You've got to understand the strategy, the risks, and also the market mood, which is understanding what does what do investors in general think of the sector in which this company you may want to buy operates in. Because if the sector is completely out of favor and market sentiment is so bad, well, even the greatest company will struggle. So you really do need to sort of think more broadly than simply one company. Have a look at its peer group as well. So when do you think about selling? Well, when the valuation is too rich is a clear one. And this is where I want to bring Greg's back into the conversation. So I think a company in its situation, it's delivered a lot of good news. It's trading on a high valuation. Its next test is the ability to keep delivering good news. So any company in this situation where it's suddenly been re-rated to sort of a valuation level that's way above its normal one, then you do have to think twice about what's that next bit of news. Can it keep justifying it? And if you're nervous about that a company isn't going to be able to deliver ongoing good news, then that might be a chance for you to think about what to do next with the stock. Some investors look at the concept of a price target. It might be they buy something on a P of 12 times and they think, well, I think this is worth 15, and when it reaches that level of 15 times, I'll sell out that point. So I would point you in the direction of a fund called J.O. Hambro UK Opportunities that does follow this disciplined approach. If you read its fact sheets and its commentary, you'll understand why it is happy to sort of sell a stock that, even though it may be rallying. Lots of investors talk about run your winners, but that isn't apply to everyone. Some people do just like this disciplined approach. You may want to sell when you need some money for something else. If that's the case, then you just have to remember, is the new idea you've got stronger than what's already in your portfolio? If you were to sell something to raise funds to make this new investment, surely it would be better to sell something where you've got a profit rather than taking a loss on something. But equally, you don't want to sell something from your portfolio that actually could reward you quite well in the future. You also might want to think about selling when the investment case has changed. Here is a great example would be the funeral company Dignity. People were buying that because it was making very large profit margins. But then it came out with this announcement saying, due to pressures in the industry, it had to completely change its pricing model. So in this situation, the investment case did change. And so that's something for you to think about. Unexpected events, something like a profit warning, you need to weigh up sort of each one on a case-by-case basis. So what's the severity of this bad news? Would you still be comfortable owning something, or would you be worried that perhaps there's more bad news around the corner? Transformational acquisitions is another one. Lots of companies may come out with impressive, exciting statements that may say, we're going to buy this other big company. Here's all the synergies that we think we're going to achieve, and this is what it might help in terms of market scale and so on. But history would suggest that some of these very big deals are very hard to get right. You tend to get problems with integration, and then they just don't really add any value. A good current example of a company that's struggling as a result of a transformational acquisition would be the software business Micro Focus. Well worth having a look to see its commentary about what's going on there. You may just have made a mistake and you want to think about selling, and there's absolutely nothing wrong with that. In fact, it's quite good for you to sort of say, put your hand up and say, no, I just got it wrong, rather than holding on to something in the hope that things weren't going right. It might suddenly become a lot better in the future. And then finally, it might simply be portfolio rebalancing. This is the concept where you might have something in your portfolio that's done very well, and it's become a much bigger part of the overall proportion of your portfolio. Quite often, investors maybe once a year would take a look at their portfolio and potentially just sell a small bit of this, the one that's done really well, so to help balance everything out. So that's my key points from the presentation. Apologies if we've had some sound issues at the start. Hopefully these are fixed. And now I'm sort of open up and have a look at some of the questions that you've been sending in. So if you just bear with me a second, I'm just going to scroll through some of these questions and see if there's some I can get to. So bear with me, just have a quick read, it'll be 2 seconds. Okay, well, we've got the first question here we've got is someone was asking, they want to put a couple of £100 into the market. They were saying, should I pick the stocks that have the smallest share price so I actually get as many shares as possible? This is a really, really good question, particularly if you are an inexperienced investor, you're still learning, and this is perhaps a classic mistake, and I think lots of people do it, and it's really good to bring this up in this discussion. You can't actually judge the value of a share by its price. It's not like going into a shop and you've got two jackets that are the same and you can see one's a lot cheaper than the other. Now, the price of a stock is actually linked to the number of shares in issue. So I should try to give you an example, hopefully to sort of illustrate this point. So if we say that company A is worth £100 million, it's got 100 million shares in issue, therefore its share price will be £1. But if you've got another company, it's worth exactly the same, 100 million, but it's got twice as many shares in issue, so 200 million, its share price will actually be 50p. You can't actually say one is cheaper than the other because they're both valued the same at 100 million. So looking at just at the share price alone wouldn't quite work in this situation. So if you think about it in another way, if you bought 5,000 shares in something that cost £1 each, that's not a better deal than if you're buying 10 shares in something that cost £500, because ultimately if they both go up by 10% in value, well, you've made exactly the same amount of money. So you really need to look at the valuation of a company using metrics that I've discussed earlier on, such as the PE ratio and the price to book. And it's kind of a psychological thing, I think, to think about if you've got thousands of shares in a stock, therefore you've got lots of wealth. But unfortunately, it doesn't work quite like that. Okay, so the next question is about valuing loss-making companies. Now, this is quite a tough one, particularly for your everyday investor. So when I sort of look at loss-making companies in terms of writing about them for Shares Magazine, I do quite often look at analyst notes because they will give me some indication about how they're valuing loss-making companies, because if you can't value on a price to earnings basis if they've got a negative earnings. So really what analysts tend to do is use a discounted cash flow model, and they're projecting a company's future free cash flow, and they discount it using appropriate discount rate. They're trying to work out the company's present value, but building a discounted cash flow model is extremely hard, and it also involves making some assumptions on the future state of a company and the industry it works in, and ultimately it's a bit of a guesswork. I mean, you could use price to sales metric, or if a company is actually sort of reporting positive EBITDA, which is earnings before interest, tax, depreciation, and amortization, you could perhaps look at enterprise value to EBITDA. But it is quite hard to value a loss-making business. Okay, I'm just going to have a look at some more questions here. Okay, so what can you do if you invest in a company that goes under? So this is, I guess, topical with situation with Thomas Cook. having just collapsed. The sad news is that you would lose your money if a company goes into administration or liquidation. What happens in administration is that you get an administrator come along and they're trying to find a buyer for the business. Now, you've got situations perhaps in recent memory like Conviviality and Patisserie, where the companies got into administration. Unfortunately, shareholders will have lost everything, but they did go on to find buyers for those businesses, and they still operate in some form today. So it's a difficult one. I think perhaps a relevant question which is related to that would be what happens if you get own shares in a company that leaves the stock market, it delists, but it's not actually, it's still a going concern. In this situation, you would either have to consider selling the shares as soon as they make that announcement. Quite often that will, they would have lots of people heading for the exit for this, and it would push the valuation down a lot. Or you hold on to shares, but you would actually own them in a private business. The problem you have there is a very illiquid stock. Who are you going to be able to sell them to if you want to get out? Now, some companies may offer the services of a third party who can help match you together. But I think from previous conversations when I've researched this topic for articles is there's very little liquidity. There are basically very few buyers. There's the odd example of a company that eventually lists again, and you would then have the stock exchange as a liquid place which for you to buy and sell. But it's a very difficult situation. But I think the number of companies that actually delist is very small, and the number of companies that actually go bust who are on the stock market is very small as well. But it's a risk that you should also consider. Okay, so we've had a few questions about funds, which are probably worth touching on, even though we've been talking about stocks as the focus is, because ultimately when you invest in a fund, inside those funds there probably a high chance that they contain stocks. They may also contain things like bonds and commodities in there as well, but I think it's probably worth touching on. So there's just a couple of ones. So someone's asking, should I always pick a fund that sits in the top quartile ranking and rides above its benchmark in terms of performance? Because they've noticed that AJ Bell's favorite funds, this isn't always the case. Well, you shouldn't look at performance in isolation when you're looking at funds. You do have to consider that fund managers can change, and so if you get someone new that comes in, you could make the argument that all that past performance may be actually immaterial to an extent. So I think when if I was looking at funds, and I know that when I've spoken to the investment team at AJ Bell that helps to put together their sort of favorite fund list, they look at lots of different things. So they'll look at the fund's investment process, the costs of running this fund, or costs that are charged to investors. They would look at people. So obviously this does include the fund manager who's in place at the moment, and also the kind of resources that the fund manager has to help him, the people working behind the scenes, and they would look at the fund track record as well. There's quite a few things that you look at there, so you shouldn't simply just buy a fund based on performance, because you never know. Stuff that's happened in the past, there may be lots of things influencing that. You just can't assume everything will stay the same in the future. And so we had another question saying, is investing in ETFs, in perhaps a FTSE ETF, is better than investing in individual companies from different sectors? So this is the idea that you'd put your money into it's like a tracker fund. So if the FTSE 100 was to move up or down by say 2% in a week, your ETF, if it was tracking the FTSE 100, would do exactly the same things. Now, the FTSE does have a lot of different company sectors in it, and it does give you that diversification, but you do have to think that it's biased in terms of some sectors. So there's a really big weighting towards banks and oil companies. So if you were wanting to invest and you didn't like those sectors, you should be aware that actually if you were in an ETF, you would get quite big exposure to them. Now, I guess it depends. If you invest in individual companies, that it could be that you've done your research and you think that you found a great opportunity. If you want to invest in funds, you're tracking the market. You're not trying to beat the market, you're simply tracking it. And this can be a really good low cost way of getting exposure to the market. And if you invest in an actively managed fund, for a small fee every year, you're paying a fund manager to beat the market. Now, they don't always do this, but I think generally you need to sort of think: what do you want to achieve, and what's your risk appetite like, and how much time can you actually spend to focusing on investing? And I think you can see from my comments I made earlier when I was going through my presentation the real importance of being able to thoroughly research business, understand what's going on. And for some people that simply may be too much work, and if it is, that's absolutely fine. That's where funds can come in, and that's you then make that choice. Do you want to use an ETF to be a passive fund, or you happy to go with an active managed fund? But unfortunately, you then have to try, and if you're going for the actively managed funds, you have to then pick the one that's right for you, because there is still quite a lot of choice. Okay, I'm going to go and have a look at some more questions now. So if you just bear with me 2 seconds, if it goes quiet, it's just my brain ticking over, trying to find ones which I think are really good discussion points. So 2 seconds, bear with me. Okay, so someone is asking about what sort of size or number of holdings should you have in a portfolio? So if you were going for individual stocks, I think you perhaps have between 10 and 20. But again, there isn't sort of an exact precise answer. But what I would want to do is to make sure I had good diversification. So a lot of investors they're sort of drawn to certain sectors. So if we give the example of the oil sector, if you had, say, 5 or 6 oil companies in your portfolio, and then maybe a couple of banks and maybe a couple of engineering companies, well, you may have picked some really interesting businesses, but that's not what I would call a diversified portfolio. Because what happens if the oil price suddenly tanks? You know how Donald Trump likes to use Twitter to comment on everything he can, and he certainly loves to comment on the oil price, and he's caused some quite really quite sort of aggressive spikes up and down in oil price. So just example is say if something happened to oil price, you then potentially have half of your portfolio going through some pain. So I think if you pick some really good companies, just remember to have that sector diversification as well. So if you were having funds in there, you would have to consider that each fund itself could be diversified. It might be that you want to hold a fewer number of funds. Again, it sort of depends on what you're invested in, but I think if you had, say, a global fund, one that tracks UK stocks, other parts of a US one, it might be something in property. So you could look at it that way. Maybe 10 would probably be enough, actually. But yes, I mean, it's a really good question. If you look at a fund, some funds hold, I don't know, 200 or more stocks. And what they're trying to do, immediately you may think, oh, they're being too diversified. They're trying to help give a smoother ride for your performance by having this very broad diversification. And they may accept that they are going to get a drag on some of their performance, but they're trying to give you a decent return, albeit it may only be a small one, by having very broad exposure. And so you don't have a very volatile performance that you might get if you've only got a few stocks in your portfolio. So there's a question here about, is it worth paying for advice? Well, I always think if you're in a situation where you don't understand anything and you find it all too complex, and you've got questions about tax, about how that affects your personal circumstances, and you want some help with broader financial planning, then it's well worth seeking the help of a financial advisor. For individual stock picking, well, I don't think you'd get many places where advisor will give you that individual stocks. They will give you much broader financial planning assistance. They may sort of be able to talk about funds a bit more than individual stocks. But I do think that if you're worried and you haven't got the confidence with stock picking, this is where you would perhaps the natural point, if you don't want to talk about tax issues, is to consider funds and having that broader focus there. Okay, so I'm going to go and have a look through some more stuff. Oh, yeah, here's a good one. So when brokers give a target price, do they expect the company to reach this, or when do they expect this company to reach this potential share price? So sorry, that was a bit of a garbled reading out. So essentially this person is asking if someone issues a share target price, when do they expect it to hit? So normally when I look at a broker research note, that target price is expected to be met within 12 months of issuing that research note. Sometimes an analyst would discuss in their note some potential scenarios. So for example, a company might need to do something in particular, in which case its target price would be X, or if it's just business as usual, its target price might be Y. But in general, I would look at a 12-month sort of idea here. And so the idea of broker forecast is quite interesting. I would sort of suggest look at the earnings forecasts in the market. So those forecasts may not be precisely based on 12 months. It's always worth looking at a financial year end. Sometimes an analyst might say, oh, in sort of 2020, I expect this company to make this amount of money. Well, it might be a company with a January year end, and so that earnings expectation might be sooner rather than later. So as always with this investing, it's always you have to read the sort of small print and try and work out exactly what's going on. So I'm just going to go get another question. Actually, I think we're looking at time, probably down to the last one or maybe two if we've got some easy ones. So bear with me a second. I'm just going to have a look here now. Okay, so someone's asking where can they access and read broker research notes. So that's a link to the last question that someone had about the price targets. There's this legislation framework called MiFID II, which is all it's complicated things. So lots of broker research notes are now not allowed to be distributed to retail investors. It's made things very hard for you and I, as the general public, to try and get hold of stuff. There are, there is a sort of a natural progression from this situation, is that you were starting to see companies actually go and pay research houses such as Edison and Hardman to go and write notes about companies themselves. And so what you very, very rarely would get a buy, sell, or hold rating on these research notes, which are freely, they're either going to be on the issuers' websites, or it might be on the company's websites themselves, or if you look at investigate.co.uk, they quite often have links to them. But whilst they don't give a buy, sell, or hold rating, what they will do is to discuss a company in quite good detail, and they may have some earnings forecasts there. So I think this is they are really valuable, and particularly for your everyday investor, it's a great place for you to go and learn a bit more about something, particularly if you spotted something because you've done your original research, you've used those valuation metrics, and you've then had a quick read of strategy, but you want to know a bit more. So I would say that they're very useful. So we have run out of time. I've got so many questions. I do thank everyone for sending them in. I'm going to go through all of them afterwards as well, and hopefully they might actually give me some good inspiration for articles that will appear in Shares Magazine. Now, all these slides from the presentation should be sent to you together with a feedback form. So if you've got time, I'd love to hear your feedback. And I'm just say thanks ever so much for tuning in, and I hope it has been useful. Investing can be quite hard, but if you put your mind to it and you understand the basics, it does make it a lot easier. Thank you ever so much. See you later.